everybody, this is Swati Gupta, Chartered Accountant. In this lecture, we will cover chapter number 2, unit number 1 of CA Final Financial Reporting. In this lecture, we will basically cover Ind AS 1 that tells you all about presentation of financial statements. Okay, let's begin and see what it has for understanding. Firstly, Ind AS 1 tells that the IFRS, that is International Financial Reporting Standards, are rule-based, are principle-based, and they are not providing any specific treatment. Okay, they are not dictating. See, these are principle-based, that is rule-based. Okay, whereas in fact they establish broad principles rather than dictating specific treatments. They do not provide any sort of specific treatment. Instead, they generalize a rule which has to be applied by each and every entity according to their needs and the nature of transaction. Okay. Now, why this Ind AS has been brought in? Because so as to serve a purpose, which was to bring in consistency, comparability, and understandable financial reporting is essential to develop a robust economy. What does it has? That in order to globalize the economy and ensure that each and every financial statements are presented in a standard format so that they are comparable, they are easily understandable. For example, if we talk about asset or if we talk about current asset, each and every organization is presenting a particular type of nature of transaction under the head current asset. Okay, so if this is standardized, the recognition measure is standardized for all the organization, for all the financial statements, it becomes easier to understand and becomes highly comparable. Okay, and therefore it can be consistently applied as well. So there was a need of consistent, comparable and understandable financial reporting system by whole of the economy, so that the economy can globalize and reach and can grow faster, robust economy. Okay, initially Ind AS were expected to be implemented by year 2001. It was brought up, it was proposed, but finally in July 2014, the Finance Minister of India at that time, Shri Arun Jaitley ji, in his budget speech announced urgency to converge the international financial reporting in the Indian context. What does converge mean over here? That means we have copied or we have adopted international financial reporting standards, but not exactly. Instead, we have included some changes so that it better accommodates in India. Okay, there are differences in transactions, in nature of economy, there are differences in different countries. So as to apply IFRS, International Financial Reporting Standards, better in India, we have adopted it with some changes. These changes are known as curves, and this process of adopting the IFRS with some changes is known as convergence. So we have not adopted the IFRS. Instead, what we have done, we have converged IFRS into Indian accounting standards. That means we have made some changes so that it accommodates in India better. It is easily applicable in India. Okay, so in 2011 it was proposed, but finally in 2014 it was announced that it should be applied henceforth. Then what happened? Now there is very basic Ind AS concept. It is given in 4 or 5 pages in your book, but I have concised it and will tell you. Okay, what is Ind AS? Ind AS are converged from of IFRS, that is adopted with some changes. That is adopted with suitable changes. Adopted with changes. If we would have adopted IFRS as it is, then we would have said that they are adopted IFRS. But instead, they are converged because we have made some changes. Now, how is this Ind AS brought every year, revised? Who does it? Who has authority? Who can issue it? Who can revise it? Okay, we'll see it right now. These Ind AS are issued by central government of India through MCA. What is MCA? Ministry of Corporate Affairs. There all ROC work, that is Registrar of Company work, is done. MCA is a portal wherein ROC work is done. Okay, so it is issued by central government And where you can find it, it is done through MCA, Ministry of Corporate Affairs, under the supervision and control, because might be we need expertise of some particular people who are expert in these accounting standards, and they are setting it by comparing and by analyzing each and every aspect of the standard, each and every aspect of a particular transaction, and then making rules for the same. Okay, so this is issued by central government in under the supervision and control of what? Under the control of Accounting Standard Board, that is IASB. This is known as IASB, Indian Accounting Standard Board. There is Indian Accounting Standard Board who does the supervision and controls the release of the Ind AS. What will be added, what should be removed, when should it be realized, any changes needed, how it should be done. It is done in supervision and control of IASB, Indian Accounting Standard Board. Okay, and then in consultation with National Advisory Committee on Accounting Standards, that is NACAS, whereas now NASCAS is known as National Financial Reporting Authority, NFRA. Now the authority is known as NFRA. Okay, so these are converged form of IFRS. These are issued by central government through MCA under the supervision and control of whom? IASB, Accounting Standard Board or Indian Accounting Standard Board. And then further, it is done in consultation with NFRA, which was previously known as NACAS. Okay, are you clear? This is the basics, or you can say history of origin of Ind AS. Okay, next. Now comes CARF. This is a very big and popular term that you must have learned or listened. Okay, this is what? This is basically the difference. This is basically the difference that has arisen between IFRS and Ind AS. Since we have converged IFRS, that means we haven't adopted it any as it is. There we have made some changes. These changes are known as CARF. If you have added something in Ind AS which is not in IFRS, the provision was not available in IFRS, but you have included while making Ind AS, then this is known as CARF in. Whereas there were some provisions in IFRS, but you have removed such thing and then removed from Ind AS. Okay, there was some particular provision in IFRS, and while making Ind AS, while converging into Ind AS, you have removed it. Then this is known as carve out. Okay, see, if there is financial impact, then we know it is known as carve. If it is non-financial impact, then it does not result into any carve. Carve in, not in IFRS. Carve in means that anything that is not in IFRS but added in Ind AS. Whereas carve out means available in IFRS but we have removed from Ind AS. I hope this is clear. In case of doubt, please reach out to me. You can even comment down below. Otherwise, if you have downloaded the app, there is chat box available. You can ask me over there. Okay. All the videos, all the PDF notes are available on the app. And where is the link? The link is in the description box. Let me know in case you need any sort of help. Now comes phases of applicability of Ind AS. Voluntary basis. Okay. It started from 1st April 2015. It was proposed in 2011, but finally on July 2014, it was announced that convergence needs to be done. Now, after converging the Ind AS, it was made applicable from 1st April 2015 henceforth. And the entities were allowed, there was no mandatory requirement, instead they were allowed to do it on voluntary basis. Okay, any company can apply Ind AS. Voluntary basis means willing basis. Now, from the next year onwards, 1st April 2016 onwards, there came mandatory phase 1. That means entities, companies with having net worth of 500 crore or more, that is greater than or equal to 500 crore, then they will have to compulsorily apply Ind AS, adopt Ind AS, prepare their financial statements as per Ind AS from 1st April 2016. Then, in the next year, came from 1st April 2017 came mandatory phase 2. In this, all the listed company or companies that are in process of being listed either in India or outside India. Okay, listed company, Second, any unlisted company having net worth above 250 crore but below 500 crore, because above 500 crore have been already covered under mandatory phase 1. 250 crores above and below 500 crore and or listed, then these will have to what apply Ind AS from 1st April 2017. Now here, if it applies to any one company, then entire group has to present Ind AS. And also there is no exit rule, that is free. The subsequent financial statements will also be presented according to Ind AS if once it has attracted or applied Ind AS, okay, either due to voluntary basis or due to mandatory phase. Okay, if any company has applied Ind AS, then entire group company has to apply Ind AS, and there is no exit rule. The subsequent financial statements have to be presented as per Ind AS. Even these criteria are not matching in subsequent years, then also they have to present their financial statements as per Ind AS. Group includes what? The holding, subsidiary, joint venture and associates. Group company includes holding, joint venture, associate, subsidiary. Okay, holding, subsidiary, joint venture and associate. Next, points to remember. There are some important points, like companies listed on SME, small medium enterprise exchange, are not required to apply Ind AS on mandatory phases. Okay, they can apply on voluntary but not necessary to be applied on mandatory phases. Once a company starts following Ind AS either voluntary or mandatorily, then they have to follow Ind AS on all subsequent years, both standalone as well as consolidated statements if threshold criteria met or adopted voluntary. Okay, or application of Ind AS has to be done to individual financial statements, that is standalone. Other than that, consolidated as well has to be provided and presented as per Ind AS. No doubt in this. Okay, so if we talk about here, there might be a question that comes into your head, that the Ind AS are applied from 2015 till 2017. Okay, so after that, if any company, if we have to judge today that if any company whether they need to apply Ind AS or not, then you have to see that firstly, is it listed company? If it's listed company, then they have to apply Ind AS irrespective of the net worth. Secondly, if they are not listed company, then you have to see that if the net worth is above 250 crore, if it is unlisted, then you have to see the net worth is above 250 crore. Okay, and thirdly, if entity wishes to apply on voluntary basis, if three of the either criteria are met, then you can apply Ind AS on the financial statements of a particular entity. Okay, next, the fourth point comes is companies meeting the threshold for the first time at the end of an accounting year then shall apply the Ind AS from the immediate next accounting year with comparatives. Okay, they have to apply Ind AS as soon as they meet the criteria. Companies not covered by above roadmap shall continue to apply the existing GAAP, that is accounting standard. They will continue to apply the accounting standards that were prevailed and that are prevailing, okay, before the Ind AS. Next comes is phases of applicability of Ind AS on Nbfc. The same criteria are there, but the dates are different, and the voluntary basis applicability of Ind AS is not allowed for Nbfc. From 1st April 2018, companies having net worth 500 crore or more. And secondly, mandatory phase 2, if listed Nbfc is there or is in a process of being listed either in India or outside India. Okay, and if we talk about any unlisted company in unlisted Nbfc, then net worth should be above 250 crore and lesser than 500 crore. Okay, voluntary basis is not allowed over here. And on Nbfc on which Ind AS are not mandatory shall continue to apply the accounting standards. Next, if we talk about insurance companies and banks, yet a date is pending to be announced, they will be applied from a future date that will be provided as a notification. Okay, since such date is not yet announced, therefore Ind AS are not applicable currently on insurance company and banks. Next comes is note, order of authority. This means in case of dispute, in case of dispute, okay, then what you need to follow? You need to follow this criteria, that preference 1 will be given to Companies Act 2013. Anything that is said in Companies Act 2013 will be upheld in comparison to other. Okay. Second priority and preference will be given to Ind AS. Okay. And third will be given to Schedule 3. This is order of authority, and where you have to use in case of dispute. If there is any dispute or contradiction or any confusion, then what you have to do? You have to give priority 1 to Companies Act 2013, priority 2 or preference 2 to Ind AS, and priority 3 to Schedule 3. Next, now this Schedule 3 has 3 divisions. This Schedule 3 has 3 divisions. Okay, how come? Firstly, the Division 1, which is applicable to company whose financial statements are required by accounting standard. Okay, so Division 1 lays down all the criteria and the guidelines for AS, for all the entities that are applying AS. Now further, since Ind AS came into picture, then a new division was added to Schedule 3, which provided the guidelines and the baselines for what? For entities applying Indian accounting standards. Okay. Now further, from 2018 onwards, Nbfc came into picture that have to apply Ind AS. So Division 3 was added further, which is applicable to Nbfc whose financial statements are drawn up as per Ind AS. Are you clear? So there was only Division 1 of Schedule 3. Further, when Ind AS came into picture, then Division 2 was added to Schedule 3, and further when it became applicable to Nbfc, then Division 3 was added to Schedule 3. Okay, so in comment section or in the query section, please let me know two things. Firstly, Ind AS are issued by whom? Who issues Ind AS? Who has power to issue Ind AS? And with whose consultancy the Ind AS are issued. Okay, these two answers I want. Okay, what are those questions? Please see that who issues Ind AS, and secondly, under whose consultancy the Ind AS are issued. Okay, let me know. What does financial statement include? Financial statement include these 5 things. In order to be a complete set of financial statements, a complete set of financial statements will be said to be complete only and only if it has balance sheet, P&L, cash flow statement, statement of change in equity, and notes to account. If it has these 5 statements, then only it will be known as complete set of financial statement. Nothing should be missing. What are those? Balance sheet, profit and loss account, cash flow statement, statement of change in equity, and 5th is notes to account. Okay, types of financial statement. These can be separate financial statements or consolidated. Form and content of financial statements will be same, but Ind AS 1 never applies to interim financial statements. Ind AS 1 does not apply to interim financial statements. These only apply to annual financial statements. Interim financial statement, it has separate standard Ind AS 34. Okay, so governing Ind AS 34, it tells you all about interim financial statements, and therefore Ind AS 1 is not applicable on interim financial statements because there is separate standard available. Next, there are some important definitions given. We'll head towards them, and further afterwards we'll see other important topics. First comes general purpose financial statement. These are those type of information that are reported for the general users that are not in a position to or capacity to ask the entity to have a particular customized report. So these are meant for general users, intended to meet needs of general users who are in not a position to require an entity to prepare the reports tailored or customized to their particular information needs. They are not in a position to ask the entity that okay, make a report according to me, according to this information. Okay, so these are made for general users. These are made to fulfill the criteria or the needs of general user. Second, things will be known as impracticable. The application of Ind AS will be known as impracticable only and only if after trying all the reasonable efforts you are not able to apply such a particular Ind AS, then only it will be termed as impracticable. Okay, see, read the definition of applying requirement is impractical when the entity cannot apply it even after making every reasonable effort to do so. What is Ind AS? Ind AS has been prescribed under section 133 of Companies Act 2013. If you do not comply with any of sort of Ind AS, then since it is mentioned in section 133 of Companies Act, then it will be deemed as that you haven't complied to Companies Act 2013. If you miss complying with Ind AS, then you miss complying Companies Act as well. Okay, it is deemed that you are not complying Companies Act properly. Next, materiality. Materiality is the concept that anything that is relevant or has a capacity to influence the decision, influence the economic decision of the user, then such information is known as material. Then such information is known as material. If it is material, then it cannot be aggregated or summed up, whereas it needs to be shown separately. Whereas if it is immaterial, that is, it does not have any impact or influence on the economic decision making of the user, then you can aggregate it and show it as in a clubbed form. Okay, see, read this if you want. What does nature and magnitude means? You have to depend that what is the extent and nature, the size extent, the variation, what is the extent of variation that will happen. Okay, the amount of impact that it will put, the extent of impact that it will put is known as magnitude. So materiality is any information that has power, that has capacity to influence the economic decision of the user. Next comes TCI, total comprehensive income. Total comprehensive income is what? It is simply, see, learn this, keep in mind, there is income and expense statement. Okay, it has two parts, P&L, it has its own income and expenses, and then there comes other comprehensive income, OCI, other comprehensive income. Income and expenses are there, and then lastly, if we total this P&L and OCI, then it comes total comprehensive income, TCI. This is addition of PL plus OCI. Okay, so we get TCI. Keep this in mind. So anything that has already been transferred to P&L but needed to be transferred to OCI, then what you need to do, you have to reverse from P&L and then adjust in the OCI portion. Okay, these are just two separate sections of the income and expense statement and nothing else. Now, when the question arises, when do you have to put a particular transaction under P&L and when there is a need to transfer a particular item to OCI item, that is other comprehensive income, when it happens? There are 9 particular items that have been listed in Ind AS 1 that has to be categorized under OCI. Other than that, all the other transactions, either income or expense, gain or loss, are needed to be transferred to P&L. Okay, so for example, if you talk about Ind AS financial instruments, okay, Ind AS 32109. So what happens is there comes a term FVTPL, FVOCI. Have you heard this? So this particularly means fair value through P&L, fair value through OCI. For example, if you are doing any fair valuation, okay, and that needs to be done through P&L. So any difference that arises on fair valuation, that difference is transferred to PL portion. And if you talk about FVOCI, then when you are doing fair valuation of any item that comes under head OCI, such amount of difference that arises on fair valuation has to be charged to OCI portion. Okay, and then when we add this P&L and OCI, there comes a term that is total comprehensive income. Let me know in case of doubt. Now, if you talk about ICI exam, okay, an ICI question answer, learn these 9 items. Learn these 9 items. Learn this all 9 items. These are list of 9 items that are needed to be charged to other comprehensive income section of the income and expense statement. Okay. And now there is a condition laid down that it should not be charged to P&L, because if it is charged to P&L and then you're charging to OCI, then it becomes double charging to the income and expense statement for the same transaction. Okay, so one particular thing is that it should not be adjusted or charged in the P&L. Second, the standard specifically must lay down that this particular transaction should be given effect to OCI item. Okay, standards should specifically ask, and firstly it was that P&L, it should not be provided in the P&L. See, read these two conditions. Items of income and expense that are not recognized in P&L will be transferred to OCI. Secondly, any standard should consider and specifically provide that it should be provided as OCI in the income and expense statement. These are 9 items. If you learn these 9 items, what help will you get? You will not get confused in entire Ind AS, because after repeatedly, it sometimes asks for P&L and it sometimes tell you for OCI. So if you learn these 9 items, you are properly ensure that these 9 items have to be charged to OCI. Other than that, all will be transferred to P&L. These are what? Like change in revaluation surplus, remeasurement of defined benefit plan. See, these you will learn and you will get to know what it is, why it is in the particular standard. Here I can only give you a list and overview. Okay. Remeasurement of defined benefit plan, gain loss arising from translating financial statement of foreign operation, gain loss arising from investment in equity instrument classified as fair value through OCI, gain loss in financial asset classified as fair value through OCI, effective portion of gain loss on cash flow hedge, change in time value of options when separating from intrinsic value, changes in value of forward element when separating from spot element, financial liability where changes are recognized in OCI. These are 9 list of items. You have to learn this if you have to appear for CA final ICI exam. Okay, this will make your life very easy, your Ind AS life, financial reporting life very easy. Okay, next, there are 8 general features that are mentioned in your Ind AS 1. We'll read them one by one. Firstly, a financial statement is true and fair. A financial statement is true and fair only and only when the following conditions are satisfied. Firstly, an explicit and unreserved statement for compliance of Ind AS has been provided while presenting the financial statement. What does this mean? Explicit means separate. And unreserved means without any if and but, without any exception. An explicit and unreserved statement for compliance of Ind AS has been made. Secondly, inappropriate accounting policy cannot be rectified through notes. That you cannot put up notes and say that the inappropriate accounting policy, wrong accounting policy have been corrected. Okay, you cannot claim that. Thirdly, departure from Ind AS is only and only allowed, only and only permitted if it is permitted by Ind AS. If the particular standard says that in case it is impracticable, for example, and they said okay, for you can depart from Ind AS and apply the same transaction as per AS. If the standard itself is asking, and prescribing that you can depart from Ind AS, permitted to depart from Ind AS, and then you depart from Ind AS, then only departure of Ind AS is justified. Other than that, it will not be said that true and fair, the financial statement is true and fair. What are the 3 conditions? See, that you have to make an explicit, that is separate, unreserved, that is without any if, but or exceptions. Secondly, inappropriate accounting policy cannot be rectified through notes. You cannot correct it via mentioning in the notes. And thirdly, departure from Ind AS only when it is permitted by a particular Ind AS. Now, going concern is what? That you assume that your business will not shut down in particular forthcoming period. Okay, for example, at least minimum 12 months, that you are not going to shut down in next 12 months. okay, and neither there will be conditions that insist and compel you to shut down or liquidate or stop trading, okay. So basically, going concern is an assumption that business entities shall continue in future without break. There is neither intention nor necessity. There is neither your intentions nor any sort of necessity to materially curtail the operations of business. Management is required to assess entities prospects for at least 12 months, okay. You have to assess at least next 12 months your business will continue and will not shut down, okay, from the end of reporting period to continue as a going concern. In case if going concern is hurt, then you have to follow liquidation basis. You will learn this in further chapters, okay. Now comes accrual basis of accounting. What does this mean? Accrual basis means this is third and this is fourth, okay. What does accrual basis mean? Accrual basis means that you are recording the transactions in your books of account as and when it arises. You are not waiting for the final settlement in cash, okay. You are not waiting for the cash settlement. You are not recording the transaction only when you are paying the cash, okay. So it is recorded on the due basis as and when the transaction arises. Income and expenses are accounted as and when due and not when the actual cash is received or paid. Fourthly, materiality. Materiality is what? Is any information that has capacity to influence, to impact the economic decision of the user. If they are material, then shall not be aggregated. If they are immaterial, can be aggregated, okay. Only material item shall be disclosed. Immaterial item can be aggregated, that is clubbed and summed up together. Now, if we talk about this, if there is, in case of disagreement, there is also a question in ICAI, if there is any sort of disagreement of the company with the auditor in case of any application and all, on applicability of any Ind AS or particular requirement of any Ind AS, and accordingly auditor may qualify the audit report. Even in such a situation, the financial statement will be assumed to be Ind AS compliant, okay. It will be assumed that they are Ind AS compliant even if there is disagreement between auditor and management, because if management has applied the Ind AS according to them and has put a explicit and unreserved statement that they have complied to Ind AS, then even in case of disagreement with the auditor about the application of the Ind AS, then also such financial statements will be termed as true and fair and will be termed as that they are Ind AS compliant, okay. The disagreement will not amount to that the financial statements are not complying to Ind AS. Are you clear? Let me know, please. In case of doubt, please let me know. In case of doubt, please let me know. Next comes offsetting. An entity shall not offset any income expenses in general cases, asset liability, but if the standard itself allows that net basis is allowed or net basis provides a better presentation, then such things can be netted, or you can say offset. For example, DTA and DTL, deferred tax asset and deferred tax liability, are always presented on net basis, okay. Now, frequency of reporting. When an entity changes the end of its reporting period, okay, either you are doing your period short or long, okay, you are extending your period from 12 months to 13, 14, 15 months, or you are cutting down your period, for example 7 months, 8 months, 9 months, 10 months. If you are changing the period, for example other than 12 months, either extending or decreasing, then what you need to do is you need to disclose two items. What are those? The reason for such longer or shorter period, the reason for choosing such longer or shorter period, and secondly the fact that the amounts presented in the financial statements are not entirely comparable, because the last year was 12 months, but because due to any particular reason you have decided to increase your reporting period. For example, last year was 12 months and current year due to some reason it is 13 months. Then what you need to do? You need to disclose two things. Firstly, the reason for adopting a longer period, and secondly that the previous amounts are not entirely comparable because the time duration is different. Previous figures are 12 months and these figures are 13 months, for example. Are you clear? What you need to do? You need to disclose this two things: reason that why you have chosen such longer or shorter period, and secondly the fact that the previous amounts are not entirely comparable. Now if we talk about comparative information, what happens? You have to present two columnar balance sheet, two columnar P&L, two columnar cash flow statement and two columnar change in equity, but one set of notes to account. Okay. And in case of change in accounting policy retrospectively, if you are changing the accounting policy retrospectively, that is from the date prior to the date from which such change is done. If you are making an impact from previous dates retrospectively, then what you need to do? You need to provide additional balance sheet, additional P&L. How come? That the earliest period, that means current year and previous year. Okay, for example, if we talk about this is current year and this is your previous year. Now what is additional over here? You have to also present the opening of the earliest period, the beginning figures of the earliest period. What is earliest period? Previous year. You have to provide the opening balances of earliest period as well when you are changing the accounting policy retrospectively. Even Ind AS 8 provides a further clarification for such comparative information. Okay, Ind AS 1 just gives you an overview. Next, eighth and last feature of financial statements comes is consistency, that any accounting policy that you have adopted, that you have chosen, should be applied consistently, should not be changed again and again unless the standard itself requires or it is better presenting. Okay, it helps in better presentation, understandability. This is also provided further clarification in Ind AS 8. Okay, your only overview is given. I hope this is clear. Let's read the example. Entity A has done a wrong classification of asset between two categories of plant and machinery. Such a classification would not be material because see, for example, a plant and machinery is a non-current asset, property, plant and equipment, that too non-current. If you are classifying, there is any wrong classification within the head, then the picture of the balance sheet is not incorrect because it is showing that okay, there are non-current asset, some heading differences there. Whereas if it was like some particular inventory, that is current asset of rupees 10 lakh have been classified as non-current asset, then this will present a wrong picture of the balance sheet. Since a particular information, if it impacts the decision of the user, then that is material, otherwise it is not. So what in this case, there is wrong classification of asset between two categories of plant and machinery. Such a classification would not be material in amount if it is affected two categories of plant and equipment. However, it might be material if it changes the classification between non-current and current. Okay, if categories are interchanged, then it might be material and it might be impacting the user decision. But if the impact is not much, the category is same, the wrong reclassification is not material. Secondly, any entity presents gains and losses on the disposal of non-current asset, including investment and operating asset, by deducting from the amount of consideration on disposal the carrying amount of the asset and related selling prices. That means they do netting, that what is the outflow and finally what you are getting in. Okay, it is always netted out, and the difference between them, the amount that was present in the balance sheet and the amount that you have sold. For example, if we talk about balance sheet, the amount that is recorded in the balance sheet, that amount is known as carrying amount. If we talk about, for example, a particular asset was recorded at 10 lakh and now it is sold at, for example, 9 lakh, and plus there was some brokerage of rupees 50,000. 50,000 was expense. So 9 lakh will be received minus this will be paid as brokerage. So your net receiving is 8,50,000. 8,50,000. You are finally receiving 8,50,000. The carrying amount was 10 lakh. Now the difference between carrying amount and the net amount that you will receive will be charged to P&L. Any doubt? No. An entity may net expenditure related to provision that is recognized in accordance with India's 37 provisions, contingent liabilities and contingent asset, and reimbursed under contractual arrangement with a third party. For example, a supplier's warranty agreement against the related reimbursement. This means that normally each and every income, expense, asset and liability are shown on gross basis. They are not offsetted unless and until it better represents or the particular index itself permits. Okay, for example, we have talked about index, we have talked about DTA and DTL. Now here, for example, there is a supplier. Okay, for example, there is a supplier and their warranty is given. For example, supplier's warranty is given agreement against the related reimbursement. Then you can do it net. You can offset it as per the provisions of Index 37. Okay, we'll read the other portion in the next lecture. Okay, I hope you understood this. In case of any doubt, please reach out to me either in comment box or download our app, the description box. The link is in the description box. Okay, let me know. See you in the next lecture. Till then, take care, be safe, stay tuned.